Hey folks, it's Dave Burrows. I want to thank you all for joining our weekly webcast. I got Diana Avigdor on with me today. It's Tuesday afternoon, and what we're going to do is go from the top and take a look at markets and what's happened over the course of the week. Just before we get going, I think that what we're going to try and do today is something a little bit more abbreviated. We're thinking about doing sort of 3 shortened webcasts per month that are sort of topical on things that have happened during the week, and one sort of fulsome top to bottom market review, portfolio review, and see how that goes. So I'll be interested in your thoughts. It's a work in progress. Try and make this useful for people. And sometimes there's lots of stuff to talk about. Sometimes there's a little bit less, but hopefully you find it a good use of time. So just to start off with, Diana is going to help me a little bit today as we go along. We're going to cover a bunch of things. We're going to cover what we're seeing on the equity side for both North American equities and global equities. We're going to touch on earnings revisions and valuations this week. We'll of course talk about market internals, what we're seeing there. There was some inflation data over the last week, which had some impact on rates, had some impact on other assets. So I want to talk a little bit about that. Of course, lots of folks have been phoning us wanting to know what our thoughts are on what's going on with the geopolitics between Trump and Putin and potential peace deal. What might that mean? We had a couple of company developments this week on positions that we're in. Of course, we'll touch on what we're doing in portfolios and what maybe changed and what we're seeing from a risk perspective. So with that, just from the top, we continue to be in the structural bull market that's been going on now over a decade, and they go on a long time. S&P on the month is up about 1.2%. So as of last week, it was probably up 25 basis points more. You can see that we had over the last 5 days, we come down above the 8-day moving average for the S&P. Of course, that's post having made new highs from the February highs. And the NASDAQ, had a tougher day today. It was down sort of 1.4%, I think, at the end of the day, but last 5 days working its way a little bit lower. And the equal weight S&P, continues to sit here below the highs from December. So that's something that we've been watching. The average stock is important. A lot of people are focused in the top 10 stocks, and we certainly own some of those, and they have a big impact on the index, and for good reason. They're world-beating companies. But these are things that we think about. We want to look at what's happening broadly across the indices and broadly across geographic regions. Now, last week we touched on earnings revisions. We were noting that companies in general had reported a really good quarter. On average, companies are beating earnings estimates by about 8%. The question is, what does that mean for earnings revisions going forward? I think analysts got pretty cautious coming into the quarter. And you can see, as we talked about last week, earnings revisions, positive earnings revisions as a percent of the total, have been working their way higher. So this is an interesting chart. It has the S&P in white, and it has earnings revisions by quarter. So in blue, we have revisions for the third quarter, which we've just entered. And then you've got revisions for the fourth quarter, which you can see are working their way higher, and revisions for the first quarter of 2026. Of course, what multiple of earnings do we pay? That's one question. What are the earnings going to be? That's another. Diana, we were talking about it in the morning meeting this morning, and you had some thoughts. What did you take away from the earnings period and the revisions that we've seen so far? Oh, I can't hear you, Diana. I think you might be muted.
Yeah, apologies. Hello, everyone. Thanks, Dave, for having me on. So we entered this quarter, and I mentioned this in prior webcasts when you were away, that the expectations were extremely low. We were expecting growth, EPS growth of about 4%. We have beat that. We beat the previous quarter as well. So it's been quite positive surprise all along. Earnings continue to do okay, although you have to be in the right sectors. You have to be in the right places. Not everybody is treated equally. We can talk about that a little later about the dispersion between how the stocks are behaving here. But, as you can see actually in this chart that you're showing, tech, communication, financials, good, energy, okay. Healthcare took the brunt of the earnings decline. So it's really a stock picker's market. You have to be in the right neighborhoods. And definitely being the market is carried to 52-week highs on just a handful. You have to be in the right place.
Yeah. It's
And
interesting when you look at the amount of contribution that the financials made. And I mean, they've been strong now for 18 months, but I thought that was a really good number.
really is actually quite surprising because in the last, I don't know, year, six quarters, it's been technology. But financials has been the theme of give back and buybacks and all the cash that they're generating now. And that's shown up in this chart that you're showing, the change in second quarter share of earnings
Yeah.
um, is financials.
So it's interesting, we have a tendency, all of us, to watch the S&P, and we like to look at some of the other indices, and the Russell 2000 we've highlighted has really been unable to get back to highs. I thought this was an interesting stat from this week. It's now been 943 days since the Russell 2000 made a new high. The top to bottom pullback in 21 and 22 was almost 34%. And you got to go all the way back really to the financial crisis for it to have taken so long for the Russell to make new highs. So that's something worth watching. You had an interesting statistic this morning talking about the average stock.
Yeah, so we've looked at what the average stock, there's a big dispersion between the haves and the have-nots in the market. So a large bulge bracket firm did this research. So the S&P, in sectors such as AI, large caps, and industrials, things are great, but people were avoiding the small cap and most defensive. And I will offer you the explanation for that, that the small companies of America are least able to absorb the higher costs that their president is putting on them. So that's kind of the explanation of that. But the 3-month return dispersion surges to 36 percentage points within the names in the S&P. And the median stock is 12% below its 52-week high. This is all by watching the index making new highs, both S&P and NASDAQ and the TSX, but it's really all comes back to being in the right neighborhood.
Yeah, it's really interesting. The companies that are generating a ton of cash and don't need financing are doing just fine. But with 10-year yields staying a little higher, the cost of capital a little bit higher for companies that need capital to finance, it's been tougher for them for sure. And there's a lot of those companies in the Russell 2000. Well, so valuation wise, we've talked about the fact that valuation of the U.S. stock market are not cheap. There's a lot of different metrics we've looked at. This is from Bank of America this week. S&P 500 is trading at 5 times book value. Last time we saw that was back in 2000, and the multiple for the S&P is at 22.5 times now, and it was at about 23 times in August of 20, and closer to 25 times in April of 99. I think one of the differences here is that some of the biggest companies are wildly profitable. And for some of the companies, like for Microsoft to have grown its cloud business by 38% year over year is pretty extraordinary. So maybe the multiple should be higher, but it's something that we certainly want to keep in mind. And when you look at private client equity holdings as a percent of their overall net worth, people are fairly fully invested, certainly in U.S. stocks. But what we do think is interesting is this phenomena where after many years of no performance, global stocks really have come to the front. And I'm reminded these are monthly bars, so this is the month of August. this is a continuation. This is the SPDW ETF. And whether we're looking at the Eurozone, which is powered on to make new highs, or whether we're looking at Japan's market, this is the Nikkei 225 making 33-year highs. This is the TOPIX index, which is 1,500 companies. This brief new high back in 1989 has only just been exceeded this month. So if we take the idea that when you ultimately make a new high after a sizable correction, you start a new bull market. This is still probably very early days for Japan. And, when the Japanese market, there's just a ton of companies making 20-day new highs. So new highs over the last 20 days, and pretty bullish overall. Nice breakout from a technical perspective. And the TSX, frankly, this is the last 4 months, the Canadian stock market, performing pretty well also. So we highlighted recently, like, look at all these global markets that are making highs. So Diana, quiz for you, like, what's the common denominator between a whole bunch of these markets that have been doing so well, after what we've talked about in revisions?
Well, Dave, I mean, you can argue that what happened with the new presidency galvanized a lot of countries to look inside themselves and, you know, do things better. You wouldn't have expected this to happen, the opposite, and yet, the flows are coming into equities. Not to mention that, if you're looking at inflationary, this is the areas where you benefit the most. It's the best hedge for inflation. Canada too. Yes, I see it in your chart here. It's also part of this global exposure and the need to diversify because you can now, because you have a return.
Yeah.
And there's lots of flows coming into all markets, global and domestic.
It really strikes me, that one of the common factors is this high concentration of financials in global markets. Like, so this is the ZEB, which is an ETF that trades in Canada that owns the 5 largest banks equally weighted. And it's just, been on a tear. And of course, we've talked about European financials, which continue to be very, very strong. Market was sloppy today, and the EUFN was down 0.03 of 1%. And frankly, like Japanese banks have been very, very strong. And in our global fund, we own the Mitsubishi and we own Sumitomo. And these are banks that have, 3% dividends that are growing dividends at 15%, but trading at, 9 or 10 times earnings. So, this is a common factor, and it certainly doesn't look like it's slowing down based on the earnings revisions for financials. So from a breadth perspective, it's sort of stayed the same. Global stocks, the percent of stocks in uptrends, the bullish percent, where we give every stock a single vote and calculate what percent of stocks are in long-term uptrends, it has continued to firm up. Percent of stocks in uptrends in Canada is similar. In the US, it's backed off about 10% from the highs. So about 10% of stocks broke down on their point and figure charts over the last couple of months. The shorter term indicators, they're still pretty benign. Percent of stock trading above the 50-day moving average. Percent of stocks with positive momentum got a little better. We'll see what happened after today, whether that's had any impact. Percent of stocks making new highs versus new lows, and the percent of stocks trading above their long-term moving average or 150-day. The index looks pretty decent, but percent of stocks at a 20-day high in the US are not high. That gives us some pause to add new positions. As you know, when breadth is narrowing, we don't add new positions. So we're not adding new positions in the US. We are adding some global positions, and Canada continues to behave pretty well. And interestingly, from a sector perspective, when we look at the percent of industries that are trading above their 200-day moving average, that has backed off here over the last week. And so we want to be a little cognizant of that. One of the things that we notice also is that, and especially you saw it today, some of the highest momentum stocks gave some back here today and over the last 5 days, and the relative strength has waned a little bit. So there may be a little rotation going on in the market. We'll have to see. But MSCI All World versus the equally weighted S&P, again, having a good month, we're now at relative new highs versus US stocks, and the TSX is the same. So Global Fund is continuing to chug along. It's now up 48% since December 23 when we launched, versus the MSCI All World in Canadian dollars at 34%, the equal weight S&P at 26. So continue to add in these areas. Okay, let's talk rates just for a minute. We've highlighted over the last little bit that very often after a first surge of inflation, you have to watch out that there might not be a second surge. So we got some PPI and CPI data over the last week. Diana, did you have any thoughts on those?
Yeah, so CPI came in line around, we're sitting in the US around 3%, and CPI in Canada came out and we're around 1.9. Everybody is watching for, and PPI, as you're showing on the screen, was much higher than expected. So everybody's watching to see where the tariffs are starting to impact. While the PPI was higher than expected, it was in the services rather than the goods. So that is implying that it's not tariff related, that is just general higher price levels. Services include things like, travel, for
Yeah, and I
example,
think it included things like
internet.
telecom and cable services and internet services
In
as well. So it's a little bit of a push.
That's right. So that's not necessarily tariff related. That's just, we're certainly in a reflationary world, as you saw in Japan. Canada is not yet affected by tariffs, as most of our goods are protected under the USMCA. And the CPI was in line, still around 3%. It's not enough to take away the expectations that the Fed is going to cut 25 beeps in September, but there's been some ideas being floated that perhaps they should cut 50 beeps, given that the employment data was a little soft, but that is likely not going to happen.
Yeah,
So
yeah.
we're likely going to see 25 beeps. This data would support it, both CPI and PPI.
Well, we always like to watch this data as it relates to the bond market because, certainly 30-year yields have been working their way higher since 2020. And really, there's been no sign of a moderation at this point. Even the 200-week moving average has turned up here for the first time. And that's a shift. So tough on bond investors. And, we talk a lot about US bond markets and the aversion, I think, that some people have to the amount of debt that there is outstanding. But frankly, you look around the world, 10-year government bond yields have had more impact outside the US than they have inside the US. So, something to keep an eye on. Now, I'm going to highlight this just quickly because, it's a topic that we've talked a little bit about. Last time we started seeing rates move higher in the 1950s, one of the assets that did get hurt as mortgage prices went up was home prices. And if you look at real home prices from 1951 to 1981, it was actually a negative rate of return, inflation adjusted, on home prices. So we're watching that closely as it relates to, big industry in the US. Housing starts continue to weaken, and existing home sales continue to weaken. So there's people who are saying, well, the home builders are pretty cheap. I err on the side of being cautious here. This month, home prices fell in 39 of the 50 biggest U.S. metros in the U.S. So just something to keep an eye on, as it relates to, our biggest assets, our residential properties. It's tough when these mortgage rates stay where they are. The other thing that we watch the inflation for is commodities, and commodities have been pretty darn good in general. Gold's been about the best performing asset in the S&P this year. Of course, I actually had a weaker day today, down a couple of percent. One of the things I think is important is that, portfolio manager allocations to gold is at 2%. So 41% of investors have a 0% weight. And I will note that recently in the first week of August, we did see a pickup in buying of the GDX, which is the gold miners index. But you can see, even though gold price has been moving higher, it took the second quarter earnings where most producers generated, excess cash flow far and away above what was expected. So you may be seeing the beginning of some multiple expansion there. We're going to continue to watch. Okay, Trump and Putin. Diana, what are your thoughts here? Is it much ado about nothing? Is there something out there? Is there a possible peace deal, and what might that mean for markets? What do you think people were watching this week?
Putin and Trump met last week in Alaska. They came out all smiles, but there was nothing cohesive that came out of it. But then Trump met with Zelensky yesterday, and all the European heads of European states all showed up in Washington, and this time they did it right. They smiled the right way and spoke the right way. It actually looks like there might be some progress on this front. So you're seeing nat gas and oil a little bit weaker. We're not going to know any outcome for a couple of weeks at least, which comes at a time when markets are really thin, end of August. But it looks as best as it has in the last little while for progress on that front.
I would say the two biggest things that people focused on, one is the crude, and whether we're looking at Brent in Europe or WTI in the US. We looked at the fact that crude has been on a weak technical footing. I mean, it's below all the moving averages, point and figure sell signal, and the S&P oil and gas exploration and production companies really, have seen weak relative strength for some time. So I guess a potential deal doesn't help things. Certainly, there was no mention of further sanctions. And the other spot that we had some questions on is, does this have an impact on the defense stocks, which of course have been dynamite now over the last 3 years? And in fairness, they've come off a little bit off the high, probably 3%, and relative strength has pulled back a little bit. But you had some thoughts on this morning that I thought were quite good, and that could be sort of mitigating here.
Yeah, I mean, it's short term versus long term, really. The world is rearming. Europe is required to increase their defense spending, and they've already, Germany already priced it into their budget. So they may be coming off a little bit because they've rallied so much. But this looks like it's going to continue to be a pretty up, or not high, but higher percentage of government budgets. And it's not one country at the expense of the other. I think it all reinflates higher. It's global, as countries are going to be buying arms from the U.S. I mean, yesterday in the meeting between Trump and Zelensky, one of the things were how and why will the U.S. Join Europe in protecting Ukraine if it wasn't allowed to join NATO. And arms are going to be delivered for about $100 billion. So, this is a sector that continues to get more money and increased budget share.
Yeah, and obviously there's some companies positioned better than others, and sort of in individual company news, we had some good week out of one of our position, good news out of one of our positions this week. Hudbay Mining, which trades in Toronto and New York, is a multi-mine operator in the copper space. Just a tremendous week last week. At one point was up about 19%. took out all the highs from 2018, took out the highs from 2021 and 22, took out the highs from 2024 and early 25. I think that qualifies as a big base breakout. The thing I think that's important here is they did a deal with Mitsubishi. Mitsubishi Corporation finances is an expert in financing mining companies. They got a $600 million financing package at a much higher valuation than was expected. So Hudbay sold them 30% of their Copper World development in Arizona. We all know Trump wants U.S. to produce copper. That's going to take some time, but this one is actually can move along. So they raised the money at 1.6 times net asset value. That's a significant premium to where people expected. They thought it might be 1 times. It means that it will be very, very accretive. And Mitsubishi, I mean, they financed the Escondida mine. They financed Antamina, which is very significant mine for BHP Tech and Glencore. They're a well-known partner, and the reality is that probably makes Hudbay a more attractive target, for a large mining company who can see this be de-risked. So I think it looks pretty good. Coming up, Diana Jackson Hole. You never know what to expect coming out of here. This is where the central bankers have a nice conversation. What are you watching for here?
Well, we're expecting, of course, we don't know, but we know that there's been some antagonism between the administration and the Federal Reserve digging in their heels and not cutting rates soon enough. We'll see whether there is some kind of change or some kind of dovishness out of Chair Powell now that we've had a couple of weaker employment reports out of the US. We'll see how much weight he puts on the stronger than expected PPI. If we look at the numbers, the inflation numbers out of the US, Europe calculates CPI by taking out the shelter component. If we took out the shelter component out of the US CPI, we would go down to about sub 2%. So, maybe he says something more dovish. I think that this could be a risky event. He's been pretty adamant, but he's now leading a divided Fed. There's been some Fed speakers that are saying that they should cut rates sooner rather than later. So we'll see how strong he will come across. It's end of August. There is some seasonality to numbers here. September is seasonally a little treacherous. It could go either way, but it's a risk coming into the end of the week.
Yeah, when I see some of the weaker breadth in U.S. markets versus global, it's one of the reasons we want to have a little bit of cash. And volatility has been very, very low, but again, seasonally, it has a tendency to pick up a little in the fall. So we came into this time of year reasonably strong. That's a moderating factor, but we want to keep that in mind. So if we wrap it all up into kind of where the portfolio is set, financials continue to be by far the biggest weight, and we now have, some good exposure to global financials beyond Canada and the U.S. The industrial companies continue to kind of chug along. We have a few of the big boys in technology, NVIDIA's, of course, to report over the next couple of weeks. Microsoft blew the doors off their numbers. Meta's performed quite well. Broadcom's performed quite well, but we do think it's a little crowded, and so that's why we have lesser weight. And there's been other things to do. The gold stocks have been pretty darn good to us. Communications have been pretty good, so we're about an equal weight with the S&P there. You can see that our energy weight now is down around 6%. We do have a cash position. Depends on the account, sort of 5 to 7%. We put a little bit more money to work in global this week, just because it continues to be very resilient. And we've got, very light weightings in real estate and utilities and consumer discretionary, because probably if there is some inflation and rates do stay sticky, this is an area that maybe has some vulnerability. One area that did pick up a little this week is healthcare. We have a very low weight there. That really was a sort of a single stock event. Warren Buffett's been a buyer of a position in United Healthcare, which has just been a horribly performing stock over the course of years. So we'll see whether that goes somewhere. Just from a risk perspective, we're watching credit spreads, but they've been narrowing. No sign of concern by corporate bond investors. We're watching volatility. Seasonally it can pick up in here, but sitting here at 15, we're right dead in the middle of bull market territory. So there's risk that it can pick up from here, but we don't want to anticipate. And overall, market is in a bull market. So we're going to watch things as they go into the end of August. And this is not a binary outcome. We iterate daily and weekly, and we'll make changes as required. If we have to get a little more defensive, we'll get more defensive. But we're very encouraged with what's happening in our move into global equities. We're very encouraged by what's been happening with some of our materials weight, and I think the sector weightings are working out okay. So, Diane, I want to thank you for joining me today, and we're going to see if we got any questions. And I'm not sure that we have any. Hold on. Q&A. One question. Where in global are we adding now? The most recent ad, Larry, was in Japan and in Indonesia. When we put on our China weight in October of last year, we had a few phone calls. That's worked out very nicely. Bullish percent, or the percent of stocks and uptrends in Asia, is actually the strongest in the world. And that would include Japan, it would include China, it would include Singapore, it would include Taiwan. So we're feeling pretty good about the exposures. We'll be doing a rebalancing at the end of this month. So we'll see where we go from there. And I got a question from Lars on MELI. Let's just see if I can pull that up for you. Hold on a second. Here I am. I got too many things open on my screen. Okay, so share that. So Mercado Libre, continues to grow, and they're sort of in the business of digital marketing and selling products and services. Shopify, we've seen in our local market, is performing really, really well. This whole category continues to take share from bricks and mortar. So I think it looks pretty good. We're expecting sort of a 22% increase in 25. Estimates for 26 are up 44%. So it's certainly not a cheap stock at 58 times earnings, but you can see, relative strength has just steadily been improving. So, it's they're using technology to their advantage for sure. And there are people hunting around global markets for good ideas. So, technically we took out all the previous resistance, and we've consolidated here above that support. Technically, I think it looks really good. So I would have no problem owning this one, but we don't currently. Next question. How long do you anticipate the bull market in gold? Look, I think that bull market in gold is still very early days. It doesn't mean it's going straight higher. We've been consolidating in the gold market over the last 18 weeks. That's about typical for the first consolidation in a bull market. We got stretched to about 70% above the 200-week moving average. So if we pull up a longer term picture, So you can see, you know, in this first push, we've consolidated since April. And we're sitting above the 21-week moving average, or well above the 50-day. There's nothing to tell me this is breaking down anytime soon. The gold miners have been outperforming the metal itself. That should happen in a bull market. If we compare silver performance versus gold, you know, you can see that silver's been outperforming recently. That's a change. So those two things tell me that we've got a ways to go. If you just looked at the most simple measure and said, well, okay, how extended is it? If we look at it from above, here we go, above the 50-week moving at 200-week moving average, it's 50% above. In the bull market of 2000 to 2011, the first move got to 89% above the 200-week moving average, and then it consolidated. So I think that there's a long way to go. If we just put up a really long-term chart, and I'll bore you to death for a minute. This is the bull market from 1971 to 1980. Gold went up 1,493%. And of course, it had some consolidations along the way. One big one that went on from 1975 through 1976, a full year. And then you got the bull market that started in 2004, went to 2011, it was up 350%. So when we look at it in that context, this bull market looks relatively early stage. And I would argue that fiscal spending and some of the geopolitical risks around devaluation of currency are probably greater now than they were in 2000. So my guess is this will be a more significant bull market. So technically, I think it's got a long way to go. I think that's it. Have we changed our thesis on Electronic Arts? No. Electronic Arts has just going through the beta launch of their newest game. This weekend, again, they had just over 400,000 concurrent users at the same time. They had people waiting hours to get logged in, 10, 20, 30,000 people at a time. So we think that there's good opportunity there. We think the multiple can double over time. I guess that's it. James, I think, will join us next week. I'm sorry he wasn't able to join us this week. He can talk through his full thesis on EA, but we think it looks very, very good. And you know, there's always market risk, and markets aren't perfect, but we think that one is set up quite well. With that, I think we're going to call it. I put up a quick poll, and if you can answer it for me, I appreciate it. And if we have not addressed things you'd like us to address, let me know. We'll touch on them next week, and we'll be back at the same time next Tuesday at 4 o'clock. Have a great day, everybody. Bye-bye.